With that background, our take and the topic of today is inflation and an oil and gas update. And our take is that inflation is not transitory. So we'll skip this. So the Federal Reserve has come out and said that inflation is transitory. They have an extremely aggressive easing program in place. The money supply has increased dramatically, and there have been real world consequences, both of their approach and of kind of the historical underinvestment in commodities and in kind of the real economy sector. The evidence that the Federal Reserve Chairman provided of inflation being transitory is this chart, essentially, or referencing the price movement in lumber, where lumber prices had gone parabolic up and where now they've fallen materially from their all-time highs. So that's basically there's many other arguments, and there are many famous economists who have made their career out of disproving inflation from a monetary perspective. Again, I'm a Chicago School economist by training, financial analyst by experience, and I think I approach things a little differently, and we'll show you how. And we already showed you that approaching things differently can yield substantial positive outcomes in the financial markets if done judiciously and if finding the right securities to get that exposure. So one thing to point out on this before we jump to the specific slides addressing this thesis from a lumber, oil, and kind of oil update market perspective is, if you see this chart, and lumber is down a little bit more since we pulled this, it's still up a lot from early 2020. It's still up a lot from 2019, 2018, and so on. And so this idea of observing a 5x price increase and then a 50% decrease as evidence of not having inflation obviously is a math problem, and it relies on people not doing math. And where people rely on you not doing math is a huge advantage. And so again, you can kind of just draw a line through this, and you can see that that the price for lumber is a lot higher than it was, and we're going to go through why that is, and then we're going to go through what's happening in oil and gas, go through some more updates on oil and gas, and then jump to questions. So there are some real world effects happening for lumber that are not really addressed in the observation that lumber prices fell a lot recently. Two things have been happening. Home building activity has been increasing, and it's almost to the record highs seen in the housing bubble that peaked in 2006. We're like real close to peak levels of home building. Home prices are at record levels. So this increases secondary market activity and secondary market demand for lumber, in addition to primary home building activity. As you can see on the bottom right, home prices are at all-time highs. In terms of capacity, so that was the demand essentially. The supply is problematic. Capacity has lagged, and part of that is it's just really expensive to build new sawmills or to expand existing ones. And the argument has been, oh, these sawmills were shut down during COVID and therefore they're not running at full capacity. As you can see on the bottom right, sawmills are actually running near their highs from a capacity perspective. Their utilization is near all-time highs, and there's extremely limited room for additional utilization of these sawmills. So supply is constrained, demand is at all-time highs or near all-time highs, and that's why you see higher prices. This isn't really driven by the Federal Reserve printing money. Them printing money obviously helps in terms of driving demand, but it's not really what drove the price here. The price got driven here by capacity being insufficient versus demand. And so lower supply and higher demand yields a price movement of the type that we saw. So we get to oil, and the argument from a inflation is transitory perspective is that oil is different. So, this is a Houston Investment Club. Everyone's kind of familiar with this stuff. You look at the rig chart and you see that drill baby drill is coming back to some extent. The shape of this chart is promising if you're in oil field services. It's scary if you're long oil. It makes it look like this time is the same essentially as last time in terms of drilling, potentially leading to higher production, potentially leading to lower prices. The other aspect of the oil is not, this time is the same, and inflation related to oil is transitory, is this claim around OPEC spare capacity, which shows a very high potential spare capacity for oil if OPEC were to just disagree, which again, that's been in the news a little bit recently. And that's the other risk. So the risks are we drill a lot this time around and flood the market again in the US, and then OPEC turns on the spigots and crashes the price. So our take is that this is not different. And again, if you recall the intro, the point of this is to find interesting opportunities from our perspective and to share these opportunities in a format like this. And so the idea is to understand the argument, understand the kind of main narrative, and then to figure out if the narrative is correct or not, and if it's substantially wrong and there are available mispricings to be able to capitalize on those mispricings. So if you looked at the last rig chart, which shows a shape that's very similar to the last recovery, and look at this chart at the top, you see that the oil price has recovered substantially, but the rig count hasn't. So the last one kind of implies that rig count is rocketing up and is just dependent on oil prices being a little higher to get back to prior levels. This chart shows that even with oil prices around where they were at the rig count peak in late 2018, at least the relevant kind of last 5-year rig count peak, the rig count's still down by about 50%. And yeah, it's increasing a little bit, but it's nowhere near where it was. We'll get into a little bit more on this, but this is very important. This time we need much higher oil prices to be able to get to supply levels, or at least supply replacement levels that we were at before. If this looks really similar to the lumber situation, that's not an accident. And we think it's very interesting to focus on lumber, see what happened to the price and how the price went up 5x, and then see the narrative to understand what's happening with oil. Similar idea on OPEC. This is a chart from Energy Aspects. They're an energy consulting firm, but there are similar charts elsewhere. OPEC has a lot less capacity than they say, and a lot less capacity than is reported. There's a lot of kind of reasons for there to be negative press about oil and gas, and there tends to be kind of an emphasis on the negatives for the industry and oversupply, and under kind of reporting on the actual situation or any sort of potential shortages or any sort of other potential kind of challenges. So this, again, like you see the chart, basically capacity is way lower. I would even question the UAE. They've made some noise recently about wanting to produce more. They may have added this 500,000 barrels a day of capacity. They may have also had some other issues in some of their other fields, and they may actually have only added a small amount of additional capacity. So got to be careful about what people actually do or are capable of doing versus what they say. And we think it's similar to the sawmills where people are saying, oh, they can add another shift or something, but where the capacity utilization is already at or near all-time highs. In terms of the narrative, it's interesting because you see these narratives of demand falling, you see, or not rising as much as people are expecting. You see narratives about OPEC being kind of negative and OPEC fighting and potentially dumping oil on the market. And these narratives often rely on sources that are historically consistently wrong. So this top right chart, I think, is one of my favorite charts in the oil and gas industry. I'll point out there's one more we'll show towards the end, which is my other favorite chart. Basically, they're relying on experts who consistently underestimate demand growth every year. And so, with like 1 or 2 exceptions. And so this is exciting because if the narrative is constructed by people who want to talk down demand, then that narrative could be potentially structurally wrong, and the whole conversation may be framed the wrong way. Similarly, you have the Saudis warning about an oil supply shortage at the same time as the headlines are talking about potential oil being dumped onto the market by OPEC. So these are obviously very different. We put out something recently, chose not to include it in this, where we were able to show that tanker rates, oil tanker rates, rose into the problem that OPEC had, where they had a true disagreement and a price war in March of last year, and they've fallen coming into this last OPEC Plus meeting. Again, we look for these kind of interesting macro things, and we try to find other sources that are outside of the norm to help us understand what's going on. So this is interesting. Like, there's not really a big reason to not believe the Saudis when they say that they're worried about a supply shortage. This is very different from what they've said before, and it's been a very long time since they've ever talked about this. And so, again, it's helpful to understand kind of who's saying what and how reliable they are. In terms of just pure numbers, oil demand growth is exceeding oil supply growth. Again, this is with OPEC supply curtailed, but it's still interesting. I think this supply chart is including estimates of OPEC Plus increasing their production by 400 to 500,000 barrels a day every month this year, starting I think in March. And so this is very promising to the extent from an oil price perspective. All of this, when I say promising, is promising from the lens of owning oil and gas stocks or having positive exposure to oil price increases. It's negative if you're exposed to inflation on a fixed income. It's negative if you're worried about inflation going runaway. And again, so when I talk about positive to the price of oil and to the fundamentals of oil and gas stocks, potentially negative to neutral to the economy, negative to fixed income, and so on. Oil inventories are depleting. They just fell below the 5-year average recently. People have again, a lot of news headlines have talked about how the 5-year average maybe is no longer indicative because it's at a higher level than the past 5-year period average. My counter argument to that would be that demand has grown substantially, so you need more. Sorry, I just got a question coming in. You need more production, you need more inventory, sorry, to meet your day's supply, day's demand, in order, essentially, like if you want to have, let's say, 30 days of oil available, that amount is higher if your demand worldwide is 102 million barrels a day versus like 85 million barrels a day. Regardless, the trajectory is extremely positive, again, from the price of oil. The question that came in was, when I say OPEC has less capacity than they announced, do I mean Saudi Arabia or Saudi Aramco also? And the answer is yes. And here is Energy Aspects forecast. They estimate that Saudi has a little less production capacity than they had in 2018. I would argue they have even less than this, but from a just directional perspective, I think there is some degree of consensus that the Saudis have less production capacity than they say, and that most OPEC plus countries have less production capacity than they say. There was one other really interesting headline around this, which was that Russia actually had extra quota capacity in the last few months, and through the most recent data, they haven't increased their production despite having extra capacity in their quota. So basically, they were able to go from, let's say, 10.5 million barrels a day to, let's say, 11 million barrels a day, and they're still producing 10.3 million barrels a day. So they can say they have capacity, let's say Russia can say they have capacity of like 11.5 or 12 million barrels a day, but if they're allowed under the OPEC Plus agreement to produce more and they're not producing more over a number of months, when that number of months goes to number of years, and when this happens with other OPEC Plus countries, and when demand exceeds supply, like we're seeing, it makes you wonder what their actual capacity is. And our view is more than wondering. We think it's highly probable that there is insufficient OPEC production capacity relative to where we're going to settle out on demand post-COVID over the next year or two. We're seeing that in the JP Morgan chart, and we think it actually could be even more extreme than this, and we think that there is risk to the upside. But if it just works out like this is still highly inflationary and very different from the story that Mr. Powell was saying. One interesting factor has been the rig count growth. So we showed the rig count is much lower than it has been in past cycles at current oil prices. And one of the factors for that is that private companies have been ramping their oil activity, drilling activity back up. Public companies have not. Public companies are actually still well below their levels from pre-COVID, and they're actually somewhat close to their levels when oil was negative, which is kind of remarkable if you think about it. Like, one, what were people doing drilling in April of last year? And two, if they were drilling in April of last year, why aren't they drilling a lot more now? And so some of this is related to a history of capital destruction, where boards have been under pressure, and thus management teams have been under pressure to stop losing money. And so that's translated to less drilling activity and more money spent on paying off debt, paying dividends, buying back stock. And then there's been a ostensible ESG push where activists and investors from a variety of perspectives have been pushing companies to spend less money drilling, more money on solar and wind and other projects like that, as well as just slowing down overall. This is extremely bullish for the price for oil, having a non-economic pressure that's building, preventing or blocking companies from spending into a price signal, which is much higher oil prices, is extremely bullish and is not something that we've seen before in the history of oil and gas, and is one reason that it's like pretty comfortable to come out and say that this is not transitory and that oil prices have significant bias to the upside in the medium to long term. This is kind of like an easy shot. 2021 electric vehicles are selling more than they did in 2020 by quite a bit. But just generally, if you think about the number of cars sold around the world every year versus the number of electric cars sold every year, it's still a fraction. Like, we're talking 2 or 3 or something % of the global fleet of new cars is electric. And so there's these stories about hyperbolic growth, about really exponential growth, rapid growth. The growth is rapid, right? There's no denying that, from a tiny number of vehicles to hundreds of thousands and maybe even 1 million vehicles this year, but it's nowhere near where it would need to be in order to threaten oil demand from the near to medium term. The very long term is uncertain, but the very long term is always uncertain. And right now, I would argue that the hyperbole in the news and in very aggressive, radically high valuation stock assessments of companies like Tesla and Nikola and whatever. I mean, some of them are just frauds like Nikola, and some would argue Tesla. And some would say also that just, companies like Tesla just don't have the production capacity. Their cars catch on fire. They have other sorts of problems that are somewhat unique to their cars in terms of claiming self-driving and then crashing into fire trucks and so on. Regardless, small percentage of the fleet, overall oil demand is growing on an absolute basis. And so every time you hear this story about electric cars, I would argue this is kind of similar to that favorite chart of mine where the narrative doesn't align with the reality on the ground. Importantly, in the context of oil and gas stocks and kind of what we do at Bison and what we're looking at, oil and gas stocks are still really cheap. So we pulled this. This is something another fund published about Canadian oil and gas stocks. It's true for the US to some extent too. Stocks are very cheap. So this tells us a few things. One is that we think it's worth doing the work and evaluating companies kind of along this valuation spectrum. Just because a company is at 2 times cash flow and not 3 times cash flow doesn't mean that it's the best investment. Some of the companies on the left side of this chart we know well and choose not to invest in. Some of the ones towards the right side of the chart we may choose to invest in, and historically there hasn't been a super high correlation in terms of picking the cheapest versus the most expensive. You obviously want to cut off the tails, but the overall performance hasn't been highly correlated. But it does tell you that there is valuation dispersion, and that tells you that you can still buy the right stocks for cheap. One other thing that you can see from this low valuation kind of setup is that the market very much believes the narrative that inflation is transitory. If the average valuation for an oil company is 3 or 4 times EBITDA, and if you can buy a whole set of these companies at way less than that, and if you can buy them at very high free cash flow yields, that tells you that the market is betting that these things are temporary and that the valuation multiples are about to expand because oil and gas prices are about to fall. And so if we're right, which again, we've been showing data in both directions, we think there's huge potential returns. And this is another reason why, in addition to Mr. Powell saying that inflation is transitory, we think it's worth doing the work. We're happy that we've done what we're showing, as well as other stuff that we're still in the process of putting together to put out in white papers on our website and elsewhere. And so there's a huge opportunity here. We didn't miss the opportunity. You know, we're long these different stocks. We showed a few of them that worked related to the macro thesis that we had and showed at the start of this presentation. And there are many more promising opportunities that we're finding. And this is still very much a active debate where the market is betting against us. And this is extremely promising to us because, again, where we've had these specific macro views, we've been really right. And we've done really well taking kind of the other side of the consensus, the other side of kind of the Bloomberg headline, Wall Street Journal headline, et cetera. And that is available here. And it's available in some cases at 2 or 3 times cash flow, which again, wild in the context of almost zero 30-year interest rates and wild in the context of a market that's near all-time highs from a valuation perspective. So in terms of the market, it is, I mean, the percentage of energy stocks, and again, this includes pipelines and oil majors and other things that aren't so interesting to us and aren't as economically levered as specific producers of the type that we talked about at the beginning that we focus on. The overall composition of energy stocks is near the Great Depression in the index. And this is, you know, this is a Bank of America slide. And, you know, it started to rebound a little bit. As you can see in the chart on the right, energy is kind of the biggest addition to indexes in as of March 31st of this year. And, you know, we think this will rebound. And if it rebounds, those 2 or 3 times cash flow multiple stocks could very easily trade up in line with the index, and they could very easily trade up way beyond that. If you look at the move from 2001 to 2008, and obviously like this may or may not be like a 2007, 2008 type time frame, the room for revaluation is enormous, and companies can trade up a lot to get to a normal valuation multiple, and they can trade up a lot as commodity prices rise. So there's like 2 drivers independent of company specifics and idiosyncrasies. And again, like we showed, getting those idiosyncrasies right, getting those catalysts right can lead to way above market performance. You know, we showed with Sandridge up almost 300% from where we announced our macro thesis versus XLE up like 30% and XOP up 100%. So really there's a lot of room to way outperform by selecting the specific right stocks, but also this industry in general, those indexes that again, these specific stocks have beaten, those indexes could go up multiple hundreds of percent just to catch up with the inline valuations that we've seen on average over the last 100 years. Another way of saying kind of the same thing, Numera, another industry consultant, put this out. Oil is the most levered way to play inflation. So if you don't believe Mr. Powell, you don't want to own gold. Gold is fine, but gold might go up 16% on average in an inflationary environment. Oil goes up 34%, again, historically in inflationary periods. So gold is good, oil is better. We'd argue oil and gas stocks are even better, and the right oil and gas stocks can be the best. And there is a tremendous opportunity to get exposure to this theme to the extent that we're right. This is a busy chart. This is from JP Morgan. It's their take on what's happening. And if you just focus on the top part, they show a 12-year upcycle, a 12-year down cycle, and they think that we are catching the upcycle. Again, we agree, but it's kind of interesting to see this from the largest investment bank, I think top 3 in the world, top 1, unclear. And again, in the context of stocks being near all-time lows and a near all-time low percentage of the overall market, this may seem obvious, but the equities, even after they've run a lot, are still radically cheap, and there's still room for the indexes to go up multiple hundreds of percent. We just saw that in those last few charts. So again, this may feel kind of like, you know, apple pie, like it's kind of obvious, but it's not priced in from a market perspective, and that makes it very contrarian, and there's room for significant revaluation like we showed. Similar concept, this is essentially my second favorite chart. There's different ways to show the same thing, but oil and gas needs substantial reinvestment, and we're not seeing it. And we're not seeing it partly because of ESG, and we're partly not seeing it because of shareholders who are mad after management teams and boards have incinerated giant amounts of capital. We're not seeing it through private equity, where many of the funds are seeing redemptions and are shifting to investing in green tech, despite that relatively slow adoption of electric vehicles and other sorts of ostensibly environmentally friendly opportunities. And this tells us that we need much higher prices in order to get those rig counts way higher. If $75 oil isn't enough to get the rig count up like it was in the last cycle, maybe it's $150 oil, maybe it's $300 oil. We're not providing a specific target. We're just sharing that this tells us, the last chart tells us, the prior charts tell us both that we need much higher oil prices in order to be able to meet the demand. Again, similar to lumber, there's been insufficient capacity investment over a decade plus period, really expensive to increase that capacity. Some of the capacity that everyone's being told we have from OPEC Plus and other places isn't there. And so it may require much, much higher oil prices than we're already seeing in order to get sufficient oil investment to fight this curve that we're showing, that's just what happens if oil isn't drilled. And again, from a demand perspective, even if electric cars were fully adopted today, or let's say fully adopted by 2030, transportation demand for oil is only roughly 27 or so percent, 28%. So you'd actually see a market that's 50% undersupplied or 35% undersupplied by 2030, because if you got rid of a third of demand, you'd still have 66 million barrels a day of demand, versus it looks like supply from this forecast would be closer to 40 million barrels a day if there was no additional drilling. So again, even if you don't believe the analysis we're doing on electric vehicles, you think there's going to be rapid adoption, you think it's going to be great, and that Tesla is somehow going to meet all their targets, even though they never have, and that these other companies are going to show up. Even with all of that, there still needs to be higher prices in order to incentivize additional development, in order to have enough supply to meet demand, as well as just to replace some of the losses that get experienced as production rolls off naturally over time. This is the last one, similar concept to the last chart. This is from JP Morgan. This shows the missing Capex from their forecasts relative to how much they expect to actually get spent. And again, insufficient Capex leads to higher prices. We saw this with lumber, where lumber prices went nuts. If oil did what lumber did, we'd be talking about kind of $200 oil. And again, circling back to the topic, if oil does this and oil goes up a lot more, then inflation goes up a lot more. And it kind of almost doesn't matter what the Fed does from a money supply perspective. Insufficient oil production leads to higher oil prices, especially as oil demand increases. Chose not to include some of the economic stuff on oil, but oil demand is extremely price inelastic. It doesn't really matter that much if oil is at 70 or 100 or 150 in terms of if you drive to the grocery store to pick up milk. It does affect a little bit some discretionary travel, but the reality is that post-COVID, there is so much demand for travel and certain other things that we may actually see structurally higher demand even at much higher oil prices. Regardless, insufficient Capex need higher prices in order to meet projected demand. And this is actually not even taking into account some of the issues with the OPEC spare capacity that we showed earlier. So we're just gonna hop over real quick to one other minor topic. Bob asked me to cover this and happy to talk about it. So we've made a effort at Bison somewhat recently to build our social media presence. And there have been various reasons to do this. I guess one reason to do it was I took over a formerly multi-billion-dollar oil and gas company, and there was zero coverage. And like, I have to talk about it a lot because no one even kind of really paid attention to it happening. We sold off assets. We earned a great return for that company and its shareholders relative to the situation when I stepped in. And I guess it was kind of one of those tree falls in a forest and no one hears it. So that was kind of the starting point of, hey, we have to start doing things a little differently, or people may just never know what we're doing. And the timing of it's worked out pretty well, because as we've ramped up some of our macro efforts and trying to find other types of catalysts, like specific local mispricings or kind of a macro narrative that's way off from reality, we've been able to put up some big public wins, and that's driven a lot of engagement. And our hope is that as we build additional wins, it broadens our exposure and makes life as a private investment fund manager a little easier. So kind of just building social engagement judiciously, carefully, within regulations, within compliance constraints, we found has been quite helpful from a business perspective, and the trajectory is quite good. And I guess one thing I'll point to is this one tweet or Twitter thread that we put together. There's different strategies that we use for this, and one of them is putting together threads from our white papers, which is just a series of tweets which include short summaries or short snippets from a thesis that, when strung together, go through the highlights of it and help explain it. And the engagement on this was much higher than prior ones. It's still very low compared to like social media influencers or some of the other kind of stuff that you'll see out there. But from our perspective, it's not about building absolute audience. It's about building engagement with other investors in oil and gas, building engagement from a media perspective, and kind of building our presence within kind of our target market. So this has been very productive for us, and it's something that I thought we'd share. You can find us easily if you look for Bison Interests Twitter account, or my Twitter account under Josh Young or under Bison Interests, as well as on our website, bisoninterests.com. You can see various white papers we've put up. We try to add links when I'm on TV interviews with Bloomberg or Al Jazeera or various other platforms. We've done some podcasts and other stuff like that as well, or participated in those. And so we found, again, that to be helpful. And then we've actually sourced some investment ideas through that too, where people have reached out to us and asked us about investments. Generally, we're not that interested, but occasionally, like, we'll always look, and occasionally we found phenomenal ideas through that medium as well. So it's very good for us in terms of sourcing investment ideas as well. So here's our contact info. Again, kind of easiest way to follow us is checking out our website, signing up for our mailing list, seeing our white papers as they come out, seeing our tweets. And then if you're interested in engaging further, happy to engage in those conversations. Again, none of this is meant as an investment solicitation or anything like that. The goal is to educate, share our very divergent view on inflation versus the Federal Chairman and Federal Reserve Chairman, and versus the market, and how the market is pricing the securities that we're involved with, as well as kind of overall oil and gas equities, bonds, et cetera. And so hopefully this has been helpful, and happy to open this up for more questions. And this disclaimer is very important too.